Today I'm doing part two on the anatomy of a market crash, but this time we're going to spend a little time on the market valuation. All right. So the question that we left with the first segment of this was, um, is there a negative liquidity event out there that is so big that it could affect the stock market in a highly negative way? That's the way we left it. And the end carry trade, people admit it's either the largest trade in the world today or is literally the largest historical trade ever. Okay, this is the biggest one ever. And estimates have been between 4 and 20 trillion dollars is the size of this trade. Some people think it's going to take 2, 5, or even 10 years to unwind this whole thing. So that's up to you to decide. So the first thing is on the valuation of the market is we're at 32.87 times PE, price to earnings ratio. And as you can see in the bottom there, the trailing 12 months was 40.4, all right? So on a historical basis, if you go back to 1929, we had set an all-time high somewhere between 27 and 32 PE. Remember, the data isn't as good as it is today. Different indexes, companies are bankrupt, are gone, talking away, merged, and so forth. So, but on the whole, we are now at a high on our PE, other than when the stock market sells off dramatically. So like when the great financial crash started, the earnings per share stayed higher longer than the stock stayed. So up went the PE ratio to these highs. So we have to kind of take the noise out of it and kind of look at like now when there's less noise, okay? The second thing is it's very hard to compare markets from the past to the future and what decade you're in. And it's like comparing football or basketball teams. We all know it's like almost impossible, all right? But there is a measurement that we can use over time, and that is what percent of the GDP is the stock market. And, we set a high in 1929 when it was 90%. So if you give an example, the numbers aren't right. If our GDP was $100 billion, the stock market is worth $90 billion. And in those days, margin was 10%, so they borrowed 90%. And I think that the debt going into 1929 was like $9 billion. We only wish that was the case today. So 90% in 1929. And here we are since basically 1974, somewhere around there. But as you can see, the stock market now is 191% of GDP, which is definitely an all-time high. Okay, we just said it. So here we are with the stock market now literally 2 times the size of our economy. Even with the market valued where it is, you have to think of something. We have basically went to 40, now we're, let's say 33 PE ratio, but we did this after we raised the interest rates 500%, 500 bips, okay? All right? So, what am I watching going into September 18th? Frankly, I'm watching the yen. We know what happened with the yen. And as you can see, it went down to 144 twice, and now it closed 146.15 on Friday. Now, to me, if this moves up sharply between now and September 18th, I definitely think the BOJ may be forced into raising interest rates again. So if they raise them by another quarter point, then what does the U.S. do? Do we cut ours by 50 basis points more to try to stabilize? It would not be the first time nor the last time central banks got together to either raise or lower or counter each other on their interest rates, rises or declines. You have to remember something. A government or central bank, you can pick 1 or 2 things you can control. You can either control the interest rates or you control the currency, right? So if you have a high inflation rate, your currency is going down, right? It just keeps going down because of the inflation. So what did people do? They raised their interest rates. Look at Turkey last year, I think went up to 65%. All right, and the same thing applies on the downside. If your stock market's under attack and the market's going down, you lower your interest rates and you don't worry so much about what your currency is doing. So you have a choice. Do you pick the currency or do you pick the interest rates? So if their currency starts going back up, which is down, will they be forced to raise their interest rates again? This is something that you're going to have to decide. And you can see how important this is. So the red line is the U.S. Japanese yen trade, okay? And we can see it there at around 144, where it is today, where they did their, and so where are we going to cut our rates to? So, and you can see the Dow Jones, we had a little down, then we just went right back up, basically to all-time highs. So what's the correlation here, right? We're going to find out in the next 18 days. So finally, when we do get to September 18th, we have to look back in the past and say, you know, we've raised our interest rates right before we've had some issues before. And in 2001, they raised it on January 3rd, and we can see the S&P fell 39% over the next 448 days. And then we raised it again on September 18th, 2007, and the S&P fell 54% over the next 372 days. So now here we are going back into September 18th again. Not sure I really like that date, September 18th, but we're definitely going to find out. So a lot of numbers, what does this mean to us? It means that we're still in the same position that we were last week, okay? Yes, there was massive intervention by the BOJ to drive down the Japanese yen. And America kicked in a way saying that, hey, you know, we may be cutting our rates in September. We think that the environment is here for that. So one, there's no scenario that the stock market, the labor market, the inflation market, that we should cut the interest rates. But we have a major financial partner in BOJ, in Japan, that has a lot of issues. They have a 2.4% inflation rate, their short rates are 25 basis points, and their 10-year is 90 basis points. People know this. That is why when you go look at that yen chart again, it's been coming down, right? It's because of this reason. So here we are, and on September 18th, the Fed has to make a decision. My only point to everyone is this decision is not made in a vacuum. The dollar is the international currency. The global financial world is connected underneath all the instruments that you and I buy, stocks, bonds, commodities, derivatives, anything you can think of. And most of that is funded at the bottom through the yen carry trade. So how's this all going to work out? I don't know. What do you think? Like and follow, and certainly tell me what your opinion is.